Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia. Thank you for joining me for another episode where we break down important investing, trading, and market concepts into practical insights that you can actually apply to your own financial journey. Today, we're going to discuss a topic that doesn't always receive the attention it deserves, yet it can have a significant impact on long-term investment performance. That topic is portfolio rebalancing. More specifically, we'll be discussing portfolio rebalancing 2026 strategies, why a mid-year review is so important, and how investors can approach adjusting allocations as conditions change without becoming emotional or reactive. Many investors spend countless hours researching stocks, ETFs, mutual funds, and other investments. They carefully construct a portfolio based on their goals, risk tolerance, and market outlook. However, what often gets overlooked is that building a portfolio is only the beginning. Maintaining that portfolio is equally important. Markets are constantly changing. Asset prices move every day. Economic conditions evolve. Interest rates rise and fall. Certain sectors outperform while others lag behind. Over time, these shifts can significantly alter the structure of your portfolio. That's where rebalancing comes into play. So let's start with the basics. What exactly is portfolio rebalancing? Portfolio rebalancing is the process of bringing your investment portfolio back to its intended asset allocation after market movements cause those allocations to drift away from their original targets. For example, let's say you started the year with a portfolio consisting of 60% equities, 25% bonds, 10% alternative investments, and 5% cash. That allocation may have been carefully selected based on your investment goals, time horizon, and risk tolerance. But imagine that stocks have a particularly strong first half of the year. As equities rise in value, they begin occupying a larger percentage of your portfolio. By the middle of the year, your allocation may no longer look like 60% stocks. It may have shifted to 70% stocks or even higher. While seeing investments appreciate is certainly positive, it also means your portfolio now carries more risk than originally intended. The purpose of rebalancing is to restore that balance by reducing overweight positions and increasing exposure to areas that have become underrepresented. Now, why is mid-year such an ideal time to review your portfolio? Many investors only look at their allocations once per year. While annual reviews are helpful, waiting until year-end can allow significant drift to occur. The first 6 months of any year can bring major economic developments. Central bank decisions, inflation reports, earnings seasons, geopolitical events, technological innovations, and changing investor sentiment can all influence market performance. Conducting a mid-year review gives you an opportunity to evaluate those developments and ensure your portfolio still aligns with your objectives before entering the second half of the year. Another important reason to review your portfolio mid-year is risk management. One of the primary goals of Portfolio Rebalancing 2026 is maintaining appropriate risk exposure. When a single asset class becomes too dominant, concentration risk increases. A portfolio that was originally diversified can gradually become heavily weighted toward one sector, one market, or one type of investment. Without regular reviews, investors may find themselves taking substantially more risk than they realize. Mid-year rebalancing helps prevent that from happening. It also helps investors remain focused on long-term goals rather than short-term market noise. Financial headlines can be incredibly distracting. Every day brings new predictions, new concerns, and new reasons to feel either optimistic or fearful. Rebalancing provides a disciplined framework that encourages investors to focus on their original investment plan rather than reacting emotionally to market fluctuations. Now, let's talk specifically about why Portfolio Rebalancing 2026 is especially relevant in today's market environment. Investors are navigating a unique landscape that includes evolving interest rate expectations, ongoing developments in artificial intelligence, shifting economic growth forecasts, inflation concerns, geopolitical uncertainties, and significant sector rotation. These forces can create dramatic differences in performance across asset classes. For example, technology stocks may experience strong growth while bonds struggle. Defensive sectors may outperform during periods of economic uncertainty. International markets may move differently than domestic markets. As a result, adjusting allocations as conditions change has become increasingly important for investors seeking to maintain balanced exposure and effective diversification. So, how do you know when your portfolio needs rebalancing? One common indicator is allocation drift. Many financial professionals suggest reviewing allocations when they move more than 5 percentage points away from target levels. If your target stock allocation is 60% and it has grown to 68%, that may justify taking corrective action. Another sign is a change in your personal circumstances. Your financial situation is not static. Perhaps you received a promotion, started a business, purchased a home, welcomed a new family member, or begun preparing for retirement. Each of these developments can affect your financial goals and risk tolerance. When your life changes, your portfolio should be reviewed to ensure it still supports your objectives. Market conditions can also provide a reason to conduct a portfolio review. Now, it's important to avoid making emotional decisions based solely on short-term events. However, major structural changes in the economy or financial markets may warrant a fresh look at your allocation strategy. And sometimes, the reason is simply that too much time has passed since your last review. Many investors become busy with careers, family responsibilities, and everyday life. Months go by and portfolios drift without anyone noticing. That's why establishing a regular review schedule can be extremely valuable. Let's walk through a practical step-by-step process for mid-year rebalancing. The first step is reviewing your current portfolio. Gather information on all of your holdings, including individual stocks, exchange-traded funds, mutual funds, bonds, cash holdings, and alternative investments. Calculate the current percentage that each asset class represents within your portfolio. You cannot effectively rebalance what you have not accurately measured. The second step is comparing your current allocation with your target allocation. Ask yourself a few important questions. Am I taking more risk than intended? Has one sector become disproportionately large? Has my diversification weakened? Does my current allocation still reflect my long-term goals? Answering these questions will help identify where adjustments may be necessary. The third step involves evaluating broader economic and market conditions. While rebalancing should primarily be driven by your objectives rather than market forecasts, understanding the current environment remains important. Consider factors such as interest rate trends, inflation expectations, corporate earnings growth, economic expansion or contraction, and geopolitical developments. Successful investors consistently focus on adjusting allocations as conditions change while maintaining a disciplined long-term perspective. The fourth step is determining what specific actions are required. There are several ways to rebalance a portfolio. One option is selling overweight assets. If a particular holding has grown beyond its intended allocation, reducing that position may help restore balance. Another option is purchasing underweight assets. This increases exposure to areas that now represent a smaller portion of the portfolio than originally intended. Some investors prefer using new contributions rather than selling existing investments. This approach can reduce transaction costs and potential tax consequences. Similarly, dividend payments can be strategically reinvested into underrepresented asset classes. The fifth step is ongoing monitoring. Rebalancing should never be viewed as a one-time event. The most successful investors establish a process for regular portfolio reviews. Some conduct quarterly reviews. Others prefer semi-annual or annual evaluations. The appropriate schedule depends on your investment style, portfolio complexity, and personal preferences. Now let's discuss some common mistakes investors make when rebalancing. The first mistake is chasing performance. It's natural to want more exposure to investments that have recently performed well. However, history repeatedly demonstrates that today's winners do not always remain tomorrow's leaders. Allowing recent performance to dictate portfolio decisions can increase risk and reduce diversification. The second mistake is neglecting diversification. A well-diversified portfolio spreads risk across multiple asset classes, sectors, and geographic regions. When diversification breaks down, portfolios become more vulnerable to unexpected market events. The third mistake is allowing emotions to drive decisions. Fear and greed are powerful forces in investing. Effective portfolio rebalancing 2026 requires discipline, patience, and consistency rather than emotional reactions to headlines or market volatility. Another common mistake is overtrading. Making excessive adjustments can increase trading costs, create unnecessary complexity, and potentially generate tax liabilities. The goal is thoughtful portfolio management, not constant activity. Before we wrap up today's episode, I want to mention a valuable resource for traders and investors looking to improve their market experience. If you're searching for a world-class, cutting-edge, and user-friendly trading platform, I encourage you to explore the Crystal Ball Markets platform at crystalballmarkets.com/platform. The platform provides powerful tools designed to help traders and investors analyze opportunities, monitor portfolio performance, and navigate changing market conditions with greater confidence. Whether you're an active trader or a long-term investor, having access to professional-grade technology can significantly enhance your decision-making process. Visit Crystal Ball Markets today and see how their innovative platform can support your financial goals. And if you're enjoying conversations like today's discussion, be sure to check out the Crystal Ball Markets podcast at rss.com/podcast/Crystal Ball Markets. The podcast offers beginner-friendly discussions covering trading, investing, macroeconomics, market psychology, risk management, and broader financial market developments. It's an excellent resource for investors seeking practical knowledge and actionable insights that can help them become more informed market participants. As we conclude today's episode, remember that successful investing isn't simply about finding the next winning stock or predicting the next market move. It's about maintaining a portfolio that remains aligned with your goals, risk tolerance, and long-term financial objectives. Markets will always change. Economic conditions will evolve. Asset classes will move in and out of favor. That's why portfolio rebalancing 2026 remains such an important discipline. By regularly reviewing your investments and adjusting allocations as conditions change, you can maintain diversification, manage risk more effectively, and stay focused on what truly matters, achieving your long-term financial goals. Thank you for listening to Financial Market Insights for Traders. I'm Sophia, and I look forward to joining you again in our next episode. Until next time, stay informed, stay disciplined, and invest wisely.